In this presentation, we will add new accounts to our chart of accounts and enter the related opening balances, then take a look at the effect of those opening balances on the financial statements within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. We're going to be going to add new accounts, but before we do so, note that we can add accounts as we enter the information into input screens, as we will do later on. In other words, if we were to go to something like if we select the plus item up top and we were to enter a check, so let's just take a look at a check and then say that we needed to add a new account, an expense account, we could go down here and add a new account as we go. That is something we will do. That's a typical process that goes forward, especially in the first couple months of entering data. At this time, however, we want to take a look at adding the account to the chart of accounts. And this is typically something that we would do when we set up new accounts, particularly, as in this case, when we have account balances that we need to enter into the system. This is one way that we can add those account balances. So let's take a look at that, and then we'll come back to this format, entering new accounts as needed as we enter more information when we enter the data input. Let's go down to the accounting this time. We're going to go down to accounting, and up top we've got the chart of accounts. That's the tab we want to be in. We want to take a look at the chart of accounts, the second tab being the reconcile. The chart of accounts will typically be generated through QuickBooks as we decide what industry we are using. We had a retail and service industry, so QuickBooks will give us kind of a default of the chart of accounts as we see here. That is usually what most people want, because although it's nice to create your own chart of accounts as you go because it's customized, most people will benefit by seeing a standardized chart of account in relation to their industry, and then being able to add new accounts as is needed for any customization. Remember that the chart of accounts will be typically in order by account type, and I recommend keeping this as a default. You could order it in other areas by just clicking here and ordering it by name. However, it's often the case you want it in the type as the ordering, because that's how it's going to show. That's like a trial balance. That's the typical format. That's basically the accounting equation. That's assets, liabilities, equity, income, and expense. Or you can think of it as the balance sheet on top of the income statement or profit and loss. In other words, we've got the types of accounts being asset accounts, accounts receivables and asset, other current assets. These are the account types, and these are the names. So these are the account types. These are all types of assets. And then payable is a liability type account. So the type is more specific. It's a payable, but it's a liability. Then equity type accounts, opening balance and owner's investments. And then retained earnings, equity. Then income type accounts, sales, service, income, cost of goods sold, and expenses. That'll typically be the way we see things. Note over here in the balance section, we have balances only for balance sheet accounts. We're not going to show any balances for income statement accounts. Why? Because the balances as of this point in time, as of today, and the income statement accounts need a time frame. So we can't give an income statement amount because we don't know what time frame. It needs a beginning and ending date, whereas the balance sheet accounts do not. What we're going to do now is add new accounts and add the open and balance related to them. Note that when we enter new accounts as we enter data input, we usually add expense accounts. So when we're just entering new data, it's usually some expense account that we're adding because we're going to be paying for something and we're going to say, that's a supplies expense. I got to add supplies expense, or that's a parking ticket. I need to add an expense related to a parking ticket. Now we're going to add some of the balance sheet accounts because we're really focusing on beginning balances. The point here is, though, most people just kind of default to expenses when they add a new account, but we really need to think about it a bit more and say, what type of account should we be adding, so that when we run into those areas where we're adding an account that is not an expense account, that we are aware of it and we know which account type and are thinking about which account type we should add this account as. First, we're going to add a bank account. So that's going to be a bank account up top. So we're going to go up top here and we're going to say new. And we want this to be a bank type account. That's the default. So here's all of our account types. Remember, this is an account type, not the account name. and we want the bank account to be the type of account, and that's going to have different formats within QuickBooks, different ways to generate the data and input the data than other account types. So it's important. And then we're going to make this the checking account. So the checking account is going to be the detail type. We could change the name to something other than checking. We might want to put our actual checking, like if we checked at Bank of America, we could Bank of America. If we're going to have more than one bank account, we may want to put something like the last 4 digits of the account number as well, because that will be able to distinguish it from other accounts as easily as possible. So if you have a lot of accounts like loans or something like that from the same bank, that's a common practice. You don't want the first couple numbers, they could be the same. You want typically the last few numbers. Then we're going to scroll down, we're going to say the balance at the beginning is $25,000. So once again, we're going to start in January 2019. We're going to enter a beginning balance and let QuickBooks do whatever it needs to do to put that beginning balance in place. And therefore, we don't want it in 2019, but in the prior year at some point, which we're going to say is 12/31/19. So 12/31/19, or I'm sorry, 12/31/18, the prior year. We need it in the prior year. So 12/31/18, and then it should, any kind of funny business should work itself out to the most part, or for the most part, by the time we enter data in January of 2019. So we're going to save that, and there is that. So there's the checking account. If we were to go to reports, then if we go to reports and see what QuickBooks did with that $25,000 we put in the checking account, and we look at the balance sheet, which is in the standard reports, probably in the favorites, most likely should be at this point in time. And if we go up top, there's the checking account, there's the $25,000. If we click on it, if we zoom in on it, and we change the date to 2018 so we can see the transaction that we have entered and run that report, there it is, there's the $25,000. Note what it put it in place as, the form it used, QuickBooks used. Even though we put it in beginning balance, it used a deposit, which makes sense because usually when the checking account goes up, it's a deposit. If we click on that, we see the deposit form. So just realize, again, if we put stuff in different types of input areas like opening balance or different areas other than using the form, QuickBooks will default typically to the related form, the closest related form it can find. And if it can't find it, it'll typically go to the journal entry and enter that, even that, it'll enter that into the registers. So let's go back down to the accounting and go to the chart of accounts. Once again, the next account we're going to enter is a credit card. So we're going to say that we pay credit cards. Now the credit card is going to be a liability. Notice it's going to be down here in the liabilities area. QuickBooks has a special liability account for credit cards, functioning a bit different than other liabilities, other current liabilities. So we'll use that. So we'll go back up top. We're going to add a new account once again into our file. It's not going to be a bank account this time. It's going to be a liability account, but it's going to be a special liability account. So it's not just going to be an other current liability. It's going to be a credit card. So this is an account type, not the name of the account type. And then it's also going to be credit card down below. That's all we got. That's what we'll use. And then over here, we could put the credit card name. If we have more than one credit card, we may want the name and the last 4 digits of the credit card or something like that, numbers that would distinguish one credit card from another. So hopefully we don't have too many credit cards, but we might have a couple in there. So then we're going to go to the balance down here. We're not going to have a sub account. We're going to say that we owe $1,000 on the credit card just to take a look at what that would be like. And once again, we're going to enter data in 2019, and therefore we will enter this beginning balance as of the last day of the prior period, 12/31/18, December 31st, 2018, to get all that messy business behind us before we start the data input in the current year. We'll save and close. If we scroll down, we'll see the ordering of these accounts. It's going to be the credit card. There it is next to the other liability, which is accounts payable, and it's got the $1,000 in it. If we then go back to the reports and check this out, reports, and we go to the balance sheet, then if we scroll down, we see that liability, credit cards. Notice it's in current liabilities, but it created a special current liability for credit cards. If we select it, let's see what it used. If we go back up top and change the date to 2018 when we enter the data and run that report, we have here credit card expense. That's the transaction type it used and the account. That would make sense. If we go into it and zoom in, use the quick zoom. Here's the expense form. So once again, it's using a form to drive the transaction even though we didn't use the form for the data input. Closing this back out and going back. Notice that both the credit card and the amount that we entered into the checking account is going to have to fall out somewhere else. It's going to be in the equity section in some way. So if we scroll back up top and we make this as of 01/01/18 to 12/31/18, run that report, January through December, by the way, January through December 2018, the last year, the year we entered this data. If we scroll down then, the opening balance equity has some of the other side of this. So if I click on opening balance equity, we can see that we have the deposit, the $25,000, and the credit card expense. So the system then just put it into this account, which you probably never heard of if you've never used QuickBooks before, called opening balance equity, because it needed to put it some other place. And that's where QuickBooks is saying, hey, this is where I put it, because I didn't know where else it should go. So it put it there, and we'll take it out of opening balance later, but it's correct in that it's in equity. So if we go back, it's in the equity section, that's correct. Probably shouldn't be an opening balance equity. Doesn't look professional really to be an opening balance equity because that's not a real account. We'll take it out of there and we'll put it into retained earnings. Let's do this again. We're going to go back to the accounting section once again. We're going to be in the chart of accounts. Now we're going to have a loan that's out, a loan payable. We owe money to the bank now. So that's going to be another liability type account. If we scroll down, it's going to be next to the accounts payable and the credit card, but down below because this is going to be more of a long-term liability. So we're going to go up and say, all right, we owe the bank. We got to put that in place and we have no account for that. So we're going to add a new account for the loan. It's not going to be a bank type account. It's going to be a long-term liability, The difference between a long-term liability here and a current liability is that the long-term liability is not typically due for more than a year. So that's usually the designation we would have. If we're not going to pay it back for more than a year, it's long-term. If we got to pay it back pretty soon, we typically call it short-term or current liability. So then we're going to say it's going to be a notes payable. That's going to be the type. So we're going to keep it at that. And then it says notes payable. I called it loan payable, so we could change the name. That's the suggested name. I'm going to call it loan payable because that's what we have in our books. We're going to say then that we owe $22,000, and once again, as of 12/31/18, the last day of the prior year, and save and close. So there we have it. If we scroll back down then to the liability section, there's our long-term liability. Notice the order. Down below, it's on the bottom of the liability accounts because it's a long-term liability as opposed to current liability. Then if we go back up top and we run that report once again, that balance sheet, going back to the reports, back to the balance sheet, which should definitely be a favorite report at this point because we've been using it a lot. And if we scroll back down, we see the liability. Notice it's not current, it's not a credit card, it's long-term. It's a long-term liability. If we select it and use the auto-zooming, changing the date up top to 2018, run that report, then we see that it's a loan payable. And notice it used a journal entry this time because it didn't know there was no form it knew how to do. Loans don't happen all the time. So there was no default form. So if we click on it and zoom into it, journal entry, debits and credits. And if you don't know debits and credits, you say, oh no, debits and credits, it's a debit. So this is really the last resort for QuickBooks to have it. If there's no other kind of thing, if it can't mask the debit and credit with some kind of form and data input sheet, then we will default to the journal entry, and that is unmasking or defaulting back to the debits and credits. There's no form because loans don't happen regularly. They're things that happen fairly unregularly. So we go back up top. We do this again. We're going to go back to accounting. So we'll go back to accounting, back to the chart of accounts, and now we're going to do a fixed asset. So we have current assets. We don't have any fixed assets because this is going to be furniture and fixture. So we have furniture and fixture. That's a long-term kind of asset. That's a property, plant, and equipment. That's something that we're going to be using for some time. So we're going to go up top and add that account because it's not there. We're going to say new account. We need a new account. The type of account it's going to be is a fixed asset type account. You can call it depreciable accounts. You can call it property, plant, and equipment. factory accounts. Sometimes it's referred to. So it's going to be the long-term tangible assets, typically cars, buildings, and furniture and fixture in our case. We're looking for, these are the subcategory types. We're looking for furniture and fixture. So we want furniture and fixture. And we'll keep it there. That's the name that's set up. That's going to be, it's matching the type. That looks good. So we'll keep that there. Now we are going to try to track the depreciation. So we're going to turn this on. QuickBooks Online Plus creates two sub-accounts for this asset, an account to track the cost and an account to track the depreciation, because what's going to happen is we're going to have the cost of the account and then it's going to be depreciated over time. We're not going to put any depreciation on the books as of now. We're going to put the amount of $75,000 as the cost, and once again the date as of 12/31/18. So we're not going to have any depreciation yet. We will be depreciating it as we put the data input in from this point forward. When you do put the furniture and equipment on the books, if it's a new company that you're looking at and you're putting furniture and fixture that you already have, then you may put it now at, you may decide to put it at the fair market value on the books and not put like the cost minus the depreciation. That might not be the way to go. However, if you're taking the data from an existing business and just entering the beginning balances into the system, then you want to take the cost and the depreciation. Also note that if you have multiple pieces of equipment and you want to track them in the system, then that gets to be a more detailed process as well. If you want to track depreciation by the type of account, we're not doing that here. We're just recording all basically furniture and fixture as one account type, and depending on outside resources to track the depreciation of each individual piece of the depreciation. We might talk more about tracking depreciation for individual units at a later time. So we're going to save and close that. And then if we scroll down, we're going to see that we should have in the assets section the furniture and fixture. So here's furniture and fixture. We have the $75,000. The related accumulated depreciation has now been created, although nothing is in it. Let's go back to the reports once again and take a look at the balance sheet and see what is in the balance sheet related to the furniture and fixture. It's going to be in the assets section. So here are the assets. Here are the furniture and fixture. Here's the $75,000 for the original cost of the furniture and fixture, no depreciation. If we select it, zooming in on it, and changing the date once again to 2018, then running that report, we will then see the input green, once again, it being done with a journal entry, the other side going to opening balance equity as we've seen in the past. If we click on that, we see those debits and credits once again, because purchasing equipment is not something that's going to be a typical transaction. It happens from time to time, large pieces of equipment, and therefore there's no form related to it. QuickBooks then had to go to journal entries. Forms first, if there is one, then to the journal entry. So we'll close this back out, go back. So we're going to go back to the report summary. And just note that if we change the dates back to 2018, 01/01/18 to 12/31/18, and run that report, some of this information, all the other, whenever we entered a beginning balance into these balance sheet accounts, all we did is say, hey, QuickBooks, this is what it should be on the balance sheet. This is what should be on the balance sheet, and you do whatever you need to do to make whatever other side, the thing balance, whatever you got to do that. And QuickBooks will put it into equity in some way. So you can see the two equity accounts that are used here. One's the opening balance equity. So if we go into the opening balance equity, QuickBooks just said, okay, I'm just going to dump the other side into this opening balance equity. If you got any problem with that, then you can go in there and take it out of there. So here's the credit card. It's in opening balance. The other side's in a liability. Here's the journal entry for that $22,000. The other side, I forgot exactly what that $22,000 was, but some balance sheet accounts on the other side. Yeah, if we click on it, we can find it. If I select this, the other side's the loan. So that's the loan, the other side's a liability. If we go out of that, there's the 75, that's the furniture and fixture. Here's the deposit that we put into cash, and this is inventory we had at a prior time. Scrolling back up, going back to the report summary. Now, everything that's in net income is going to roll into retained earnings. And so let's check out what's in net income should be on the profit and loss statement. So if we then go to the reports, that 5,500 should be on the profit and loss for the same time period. We look at the profit and loss statement and change the dates from 01/01/18 to 12/31/18 and run that report. Then there's the 5,500 in the profit and loss. And here's this information. We haven't entered any information yet. So this has to do with sales, that when we entered the beginning balances, and we didn't do this time. This has to do with when we did the entered new customer balances. But note, as we enter these beginning balances, messy things can happen. And the 15,000 also didn't happen this time, but just note, messy things happen. QuickBooks puts them in different places. However, if we go to the next time period, 01/01/19, the date that the year where we're gonna enter data, 12/31/19, and run that report, we see nothing's in it. It's ready to go. It's zeroed out. Everything's gone. We're good to go. So all the messy business in 2018, if you want to run a report for 2018, can't do it because we didn't start the business there, although we have some data. That is our beginning balance data. That's us just making the system, making the balance sheet right. And now we're good to go forward in 2019. Beginning balances in the balance sheet being correct. Almost, we're going to fix them a little bit up in a bit, but close. And then on the income statement, there's nothing in it for 2019 because we haven't entered any 2019 data for the temporary accounts. Also note another report that's really useful if we're doing this. Accountants typically use this report. It's good for the beginning balances and to check our work. So we can go to the reports. We're looking for a trial balance. So a trial balance is going to be kind of like a list of accounts, and it'll help us to basically see our work. So I'm going to scroll down. I'm going to minimize this. It's not going to be in the business overview, not in the who owes you, not in the sales customers, not in the what you owe. It's not in the expenses and vendors or the employee. It is in the for my accountant. So for my accountant, if we scroll down, we're going to say this is going to be a trial balance. We want to take a look at the trial balance. You can also search for it up top. Take a look for the trial balance up top. We're going to select that item. And then if we look at the trial balance for the year end 2018, 01/01/18 to 12/31/18, and notice you should just be able to put it in there as of December 31st, 2018, but I used the full range. And then there we have our information so far. This is a nice list of accounts. You don't have the subcategories, although you do have debits and credits. You don't need to know really what they are, however. You just need to know, well, this is the balance that's in there. And there's no subcategory, so it's nice and clean. Good way to check our work. So if you're following along, check your work in comparison to this. If your work does not match up to this, then it's probably a date thing. It's probably the case that you entered something later than 2018. So in that case, change the ending date. Let's just take a look at it real quick. 25,000 for the checking, accounts receivable 20,500, inventory 2,896, furniture and fixture 75, 15,000 accounts payable, 1,000 for the Visa, 22,000 for the loan payable, 79,896 for the opening balance, 20,500 for the sales, and other miscellaneous expenses. So keep those in mind, and I'll show you this date thing in a second here. So the dates are it's probably the case that you entered something and it defaulted to the current day, which means that something may not be included. So now let's check these same numbers, but now for the year 2019, the current year that we're going to start entering data in. You'll note what will happen. These two accounts will go away, and they'll roll into the retained earnings, which we don't see here yet because nothing's rolled into it yet. So these two accounts, the combination of them, in other words, which is a credit of 20,500 minus a debit of 15,000, 5,500, should then appear in retained earnings. Everything else should remain the same. So if we scroll back up and we're going to say 01/01/19 to 12/31/19 and run that report, there we have it. Everything's the same. There's that 5,500. So now we're good to go going forward. There's no income statement accounts in 2019. Nothing's in the income statement accounts. That's the way it should be because we have no activity. No activity has happened yet. So it's all in retained earnings, but we have this opening balance equity we should adjust for. That's not proper. It's kind of ugly to be there, but it's in equity. It should be in retained earnings if we're just going to keep these equity accounts, which we will. Now, once again, if your accounts don't match this, then it could be that you entered something like way out on the date. You know, it's usually a date thing. So if you put your date way out to 2020, if it was prior to 2019 or 2018, it should still roll in there somewhere. You might not be able to drill down on it as easy, but it should still roll out. If it's past this, then you just want to increase the date and see if it's a date thing. And then if it's you still can't find it, find the area we are not in agreement with and click on it. So like if inventory was off, zoom in on the inventory and change the dates to 2018 to see the data, run the report, and then you'll be able to see the activity. So you'll see the activity and you'll be able to see kind of what adds up. We'll take a look at another report later on when we make some end of the period adjustments. So if you're not totally lined up right now, that's okay. You can continue forward, and then we'll go back and we'll take a look at another report that's really good for checking our balances. Also note that QuickBooks is very forgiving if you need to change. So if I needed to change like this 400, then you can just go into the 400. And if you need to change the date, if the date was wrong, you can change it. If the amount was wrong, you could change it. And so QuickBooks allows you to go back in and basically change anything, which has its pros and cons. But that's how you can go in and you can make adjustments to it if necessary and when necessary. For more accounting information and accounting courses, visit our website at accountinginstruction.info.